Friends, on behalf of Roundtable and Roundtable India, I'd like to welcome all of you to this beautiful session that we're having to educate all around the whole aspect of equity investments and financial planning. I would like to start off by introducing Roundtable. Roundtable is an international organization which is focused on creating a positive impact for the world. We are a group of people below 40 who work along with our families and make sure we have a better society to live in. Roundtable India currently has more than 4,000 members, all who come together for fellowship, for service, and like I mentioned earlier, to make the world a better place to live in. In India, today, we are very focused on building classrooms. We've built more than 5,000 plus classrooms across different schools for the underprivileged. And we are absolutely honored to do the kind of work, specifically during the COVID situation, where the need of the hour is to help those who have been impacted. One of the facets of Roundtable India is the leadership and personality development facet. Today, we are doing an event in order to accommodate that particular facet of ours. I'm very happy to have our two stalwarts in the financial industry, Tarun, Birani and Mr. Maran along with us. But before I hand over the baton to them, I'd like to particularly thank the 5 areas that have come together to collaborate and bring this entire event for you online. I'd like to thank Area 3, Area 4, Mr. Mohit Beriwal, Area 5, Mr. Ashish Killa, Area 11, Mr. Prashant, and Area 15, Mr. Sanchit. Thank you so much, friends and brothers, for coming together and making this possible. We're hoping that those who are not from Roundtable also get tremendous value out of this, because this is for everybody. And if you are below 40 and would like to create a positive impact of the world around you, please do reach out to us. Please be a part of one of us. I'm going to start off by introducing Tarun. Tarun Birani is a dear friend, a certified financial planner who runs a boutique investment SEBI-registered firm called TBNG Capital. His entire reservoir of knowledge he invests into helping busy professionals, women entrepreneurs, family offices, and business owners. Tarun has been a keynote speaker at various financial forums and helping people understand the concept of behavioral finance. He coaches a lot of people, including me, on making sure that I'm saving right and I'm making sure that I'm reaching my financial goals and achieving financial freedom. Tarun has also been on various financial forum panels such as ET Now, Hubis Wealth. He contributes regularly to Money Control, Live Mint, Economic Times, DNA, ET Wealth, Times of India, and Bloomberg Quint. Before I hand over to Tarun, thank you, Mr. Maran, for sparing your time to come and share your knowledge with us. Tarun, I would like you to start off by introducing the topic today and then introducing Mr. Maran and taking it forward with us. Thank you so much, Tarun.
Thank you, Rashesh, and thank you, Roundtable, for inviting us for this lovely session, which you are going to witness over the next couple of hours. So, I think the important part, which I've been always thinking, that what makes an investor very successful, and I think Mr. Maran is with us. He's an encyclopedia in that, so I'm sure he's going to give us a lot of insights on that. But what has been my experience in last 20 years, whatever small I could understand about investing, there are 3 things which makes investors successful. One is people with less mental clutter. How can we reduce our mental clutter? I think those are very successful. Second, people who keep honing their creativity through reading. I think reading is one of the most important part in investing, who continuously keep reading, understanding the worldview. I think that is again very critical. And the third and most important part is the collaborative relationship with people who have complementary skill set. Again, that is a very critical aspect if you want to be a successful investor. And I think with this roundtable platform, we are trying to bring this collaborative nature, that how can we help and reach out to like-minded people who want to create wealth. And I think that is the way how to grow together. Yeah. Without taking much time, we will start with Mr. Maran's session. And let me give a quick introduction about Mr. Maran. He is one of the Unify co-founders and currently hold position of executive director. He has experience of 27 years in capital markets and has worked with some of the leading names in the financial markets. Currently, he manages investment for some of the Unify's most important relationship and has also been instrumental in spearheading Unify's initiative into niche investment strategies as well as new geographies. He converts simple ideas into valuable investment opportunity. Mr. G. Maran based his extensive research in capital markets, collates information in a lot of Q&A format. He has done a lot of sessions around it. He's one of the best speaker on this topic as we speak today. So today he's going to talk about, we are witnessing a lot of activity where promoters are buying stakes in their company. And I'm sure Mr. Maran will give us a lot of insight that how Indian promoters are the best contrarians and are they buying now. So maybe Mr. Maran, you can quickly give us more insights around that subject. Thank you so much.
I've been too generous in the introductions, but one correction, I'm not a CFA.
Oh, sorry.
For that matter, I haven't finished anything that I began. So you can say I'm a dropout, and therefore feel proud that I'm in the same league like many famous dropouts. This specific topic, when you mentioned to deliberate, how we ended up tracking insider activity was about 20 years back. I began my career in Madras Stock Exchange in early 90s and spent 10 years working with various broking, banking firms. And then 2001 happened, when you had September 11 attack, IT meltdown, NASDAQ fraud. And usually when markets decline very sharply, like in 2001, Indian Sensex fell 65%. And many frontline IT stocks like Infosys, Wipro, they all fell 70-80%. In those days, our GSEC yield, Government of India's borrowing rate, used to be 13-14%. State Bank used to offer little higher interest rate in their FDs. And therefore, equity was a bad word. And but we used to get a few offers, public offers, tender offers, buybacks. And since the price is already known, and these are all tender offers, we used to buy in markets and tender. And in global markets, they used to call this as event arbitrage. What is arbitrage? You just buy in market and give it to someone who is making a public offer. Because as soon as the offer comes, the price in market will go towards the offer, but it won't reach the offer price. It will come somewhere close and then stop. So we did that for a year or two, made decent return. But we started asking the question, why should the buyer buy? Why is he buying? And we kept tracking these actions for quite a few years. what happens 1 year, 2 year, 3 year after the promoters or who makes the public offer? What happens to the company, the share price? And it was quite a revelation. And by 2004-5, Indian economy started doing well. Equity market started doing exceptionally well. And then you suddenly saw these offers drying up. And we were extremely busy with our event arbitrage transactions in 2001, 2, 3, 4. But 2005, not too many. 2006, even less. 2007, we couldn't get much offers. And then 2008 happened. Index was 20,000 in 1st January 2008 and fell below 8,000 by October 2008. Again a 60% decline. Whole world was in paralysis. No one knew how to act, how to react. But then suddenly we started seeing a lot of activity in terms of buybacks, creeping acquisition, tender offers. And then we didn't need a statistical data point to validate. It was quite obvious that there is some kind of a inverse relationship. And then we built some thematic approaches to investing around this line. So over the next few slides, I'll just share with you our own learnings by closely tracking these. This is almost a 13, 14-year journey now for us. There are some interesting insights that we could get. Some inferences that are very relevant. But some of these insights and inferences are very unique to India. As that makes it even more interesting. There are a lot of study material, research, anecdotal evidence in global markets about any strategy, any investment philosophy. Some of them are relevant in Indian context, many of them are not. But some of these inferences which are unique to India, which you can't find in multiple markets or economies, especially Western economies, you won't find much of this material widely covered in research. Yeah, next slide. How come promoters see value and opportunity when investors see only risk and uncertainty? Is it true? It is. When markets declined, the way it declined last March 2020, we attribute that to COVID and COVID related news flow. And suddenly investors could see significant amount of risks and uncertainty. But around the same March, if you look at the Indian promoters, the number of companies where such promoters buying happened in March 2020 is almost 10-11 year high. So what is that they saw as an opportunity? What is the value they saw in that opportunity when all that investors could see is only the risk and uncertainty? Is what we will be covering in the next few slides. Before that, next slide. When we say promoters, insiders, we sometimes use these words together as if we tend to think meaning is same. When we say promoters, the family or the group of entity which own controlling stake is one meaning. The board, the executive management, they are also insiders. Why making this distinction I'm trying to make in the beginning itself is the definition of insiders could mean different in India. For example, owner management. If you take our Sensex 30 top 30 companies in India, about 23 out of these 30 companies, promoter stake will be 40, 50, 60, 70%. If you take, say, Dow Jones Index, top 30 US companies, in 28 out of 30 companies, you can't find any promoter holding above 10%. They won't even have 10%. In 28 out of 30 Dow Jones companies. If you take the BS 500, the top 500 companies in India, maybe about 370 plus companies, promoter holding will be 50% or above. Whereas if you take S&P 500 companies, not even 20-30 companies, you will find that. In US and most Western markets, the owner management is different. Executive management is different. The ownership will be highly institutionalized pattern of holding. Executive management will be independent board professionals who run the firm. Whereas in India, in majority of the firms, both are one and the same. And that one critical distinction we should make when we discuss insiders, promoters, activity in Indian context. The next slide explain how our markets are composed of. There are 1,900 plus companies listed in NSE, many more in BSE. The market capitalization of India right now around 2 trillion. Before COVID fall, it touched as high as 2.1, 2.2. In March end, it was about 1.7, 1.8. If you take $2 trillion market cap, that's a market capitalization of all listed companies in India. The top 30 Sensex companies is about half of India's market cap. We may have 4,000 plus listed companies, but the top 30 companies are as large as company number 31 to 4,000. Actually, if you take the largest company, that's about what? Reliance Industries. It has 14 lakh crores market cap, close to $200 billion. That's about 10% of India, one company. And if you put the next 3-4 names like TCS, HDFC Limited, HDFC Bank, about 25% of India will be 5 companies. But 50% of India is 30 companies. That is Sensex. Then people refer Nifty index just to judge how the markets are. Those 50 companies in Nifty, they're about 2/3 of India's market cap. And if you take the next 50 companies, totally top 100 companies, that's almost about 80% of India. It's not that this is a recent phenomenon. Even 20 years back, the top 100 companies were about 80% of then prevailing market cap of India. India has always been skewed. But if you take US markets, the S&P 500 is less than 80% of US market cap. Some people take the top 3-4 companies like Apple, Alphabet, Microsoft and say that it's also skewed there. But the skewness may be there for the top 3-4 companies. But if you take top 500 companies, it's less than 80% of their market cap, where even the top 100 companies itself is that much of weight in India. So that's how Indian listed equities market capitalization is spread. But who owns these shares, this 2 trillion ownership pattern? Promoters own 55%. If you take all the companies listed in India, small cap, mid cap, large cap, index, non-index stocks, across sectors, PSUs, private enterprises, all put together, all the companies, promoter stake is 55%. FIIs own about 20%. Domestic institutional investors, which includes all mutual funds in India, LIC, private insurance companies, AIFs, all domestic institutional investors put together is about 13%. Equities, listed equity space. Then rest of the investors, non-institutional investors, people like you, me, portfolio managers, retail investors, HNIs, family offices, put together is about 12%. So the ownership of 2 trillion is spread across 4 types of shareholders: promoters, foreign institutions, domestic institutions, and rest of the people. If you take the FIIs for a minute, it's 20% of the entire market cap in India is owned by them. But if you take the floating stock, because promoter stake usually doesn't trade, when we build Sensex and Nifty, it's based on free float market cap, which means they take into consideration non-promoter holding and then calculate market cap, and that's how weightages are assigned. So TCS may have higher market cap than Infosys, but Infosys will have higher weightage than TCS. So in this free float, FII's ownership is almost 20% of total and maybe a little more than 40% of the free float. So significant. Which is what makes any discussion on Indian equities not conclude without discussing FII activity or FII ownership or FII buying, FII selling. But this FII ownership, which is 20% of 2 trillion, that's close to about $400 billion. If you are the FII and you have this 400 billion invested in Indian equities, how will your portfolio look like? About 1/3 of your portfolio is just top 4 stocks. Same Reliance, TCS, HDFC Limited and HDFC Bank constitute 1/3 of FII investments in India. And the next 46 stocks in Nifty 50 will be close to about 50% of FII holding. So about 82% of FII holding in India is Nifty 50 companies. So FII entry as well as exit gets more reflected in the way Nifty moves up or down. But their influence over the non-Nifty stocks is much less. If you go down the company number 100, 120 in the market cap picking order, you won't find any ownership dominance of the FIIs. If you go down company number 200, 300, you may not find any FII holding at all. If you go down company number 400, 500, you won't find mutual fund holding also. So that's FIIs. If you look at promoters holding of 55, maybe in Sensex 30 companies, you may find 6-7 companies like HDFC Bank or Infosys, where promoters holding may be 5, 10, 15. Almost the entire float is free float. But that's not the case in most of the broader market stocks companies. So the next slide, this gives you a sense of how much of various indices in US are owned actually by institutions. So if you take S&P 500, which is this bar, the third bar, that's about majority of US, 80% of US is in this, and 80% of that is held by institutions. So I'm repeating, 80% of US market cap in equities are owned by institutions, mutual funds, pension funds. And the promoter holding in US will be single digit in majority of the companies. In the next slide, you have an idea of what is the average promoters holding in different sizes of companies. The top 100 companies, so-called large caps, promoters holding is close to 53%. The next 150 companies is 59 mid caps, next 250 is 56 small caps. Yeah, the next slide. This promoter stake that we look at, it's a myth among investors to think promoters holding is a constant number. Actually, they are not. There are various companies, if you look at the promoters holding over 5, 10, 15, 20 years, you will find them moving from 50, 55, 58, sometimes 48. It may look like a small spread, but 50 moving to 55 could be $100 billion, could be 6-7 lakh crores. Large. And this stake increases, decreases, happen all the time. The frequency of this could be less in certain market cycles, could be more in certain market cycles, but they do happen. There are companies where promoter stake would not have changed for long periods. There are also companies where promoter holding would have changed every year. It's very important to observe promoters holding, at least in a country like India, where they are the dominant shareholding class of investors. Their relevance is universally accepted. Many value investors look at that data point carefully. But that relevance is a lot more in India than in most of the Western markets. How do these promoters actually increase or decrease stake. Even though in this slide we put different methods in promoters use in increasing stake. How do promoters decrease stake? Not exit stake. Exit stake we all understand. They just sell the business, they just sell their stakes to an acquirer. But in the first place, how do they decrease stake? They come out with an IPO. Majority of the companies that see IPO, prior to IPO, would have been 100% held by the promoter. After the IPO, they own 75 or 90 or even less than that depending on the size of the IPO. Then you also find various what we call as QIB issues, which is qualified institutional placements, whereby the company raises equity and different types of these promoter dilutions like IPOs, QIBs, all that happen when markets do very well. How do they then increase stake? Usually when markets are depressed. So they increase stake when markets are depressed, but if you look at the previous slide, yeah, I'll tell you, Tarun, and to shift the slide. Creeping acquisition markets is the most dominant type promoters use. What is creeping acquisition? They keep buying stock in market. This is well regulated. SEBI has two regulations governing this aspect. One is Substantial Acquisition of Shares Takeovers Act. Other is Prohibition of Insider Trading. So promoters are allowed only to buy up to 5% before results announcement. They should not buy. There is a lock-up period. There is certain pricing limitations. All that, it's reasonably well governed. Second is preferential shares issue. The promoter can make the company to come out with a preferential issue of shares. There are some companies where these issues are made only to promoters. Obviously, because it's a related party, it should also be voted by other shareholders, majority of minority investors. But such issues, pricing will also be SEBI governed. It has to be higher than 2-week average, 6-month average. Same is the case with warrants, in which case it's like almost like an option. Company allot warrants to the promoters, which they can choose to exercise and choose to not to exercise after 1 year, 2 years. Earlier, some promoters used to misuse this provision where they make company to issue them warrants, and if the pricing is attractive, after a year or two, they may exercise, and if the pricing is not attractive, they may choose not to exercise. Then SEBI has made it even more stringent when you have to make a 25% margin, and if you don't exercise, then you cannot reissue. Those kind of things. But still, there are companies where promoters use this route to increase stakes. Then rights issue. How do rights issue come into this list? Actually, it took some time for us to understand. Even though rights issue is rights for every shareholder. Rights issue cannot be issued only for promoters. It is issued for you, me, every shareholder, institution, non-institution. But what happens when a company comes out with the rights issue in bad times, in bad market cycles? Many public shareholders may not subscribe to the rights that they are entitled to. And any unsubscribed portion will be subscribed by the promoters. And therefore, their stake in the company post rights issue will be higher than what it was pre rights issue. But then why we see high number of rights issues in companies which are not in market fancy, or at times when market itself is depressed? Is because when you do creeping acquisition, you have to pay the price at which the stock is currently trading. And if your appetite to buy is large and what is trading in market is not that large, because of your own buying order, the price in market could go up when you buy large quantities, which is what promoters would like to buy. Even for their stake to go from 50, 51, 55, they have to buy significant quantities, which could lead to market price going up, and they may have to pay that price. If it is preferential issue, the price has to be much higher because it has to be higher than SEBI formula, which also will take into consideration the 2-week average, 6-month average. So you cannot benefit from a sharp market decline, because even after the market price decline, if the company has to allot preferential issue, the pricing premium should reflect the 6-month back prior to market fall pricing. Same is the case with warrants. But in rights issue, the company can price the rights issue significant discount to current market price. Recently, there was a reasonably well-known company whose price in market was 180 rupees and the rights issue was at 50 rupees. And good number of retail investors did not subscribe, and promoter subscribed more than his entitlement, and his stake went up. So in a stock which is trading 180 rupees, promoter could increase stake in the company at 50 rupees per share. But in all these 4 cases, promoter has to incur a cost. Either when buying the market, he has to pay the broker. In preferential allotment, he has to pay money to the company to subscribe. When warrants get converted, he has to pay money to the company. In rights issue, he has to put money to subscribe. But the 5th option, which is promoters not participating in the buyback, promoter need not have to do anything. Company can do a buyback, which is open for all shareholders, promoters as well as non-promoters. And obviously these buybacks, when they are at a good premium to market price, some of the retail investors who want to exit could exit. Promoter choose not to exit. So before a buyback, if the equity is 100 and promoters are holding 50, if the company is doing a 20% buyback, post buyback the equity could be 80, promoter may continue to own 50. So 50 out of 100 earlier was 50%, now it is 50 out of 80, and therefore it could be 62%. These are all different methods promoters use in increasing stake. The next slide. Here, this is probably the most important part of my presentation. You find red lines and you also find bars. The red line is BSE Midcap Index. The bar is number of companies promoter stake that goes up within BSE 500 companies. And if you look at the red bar, which is the index is put on the left hand side numbers, and the bars is number of companies that is put on the right hand side y-axis. So in 2007, market went through the roof between 2007 and 8. That's the last year of the bull market. So midcap index went from 4,000 to 10,000 from 2006 to 2008 in 2 years. In 8 quarters, index went up almost 150%. And then the 2008 big fall happened. From 10,000 it fell below 4,000. And when index fell sharply in third quarter of 2009 FY, which is October, November, December 2008, you found the bar the steepest upward. And again, when markets moved up in 2009-10, you found less and less companies, promoters increasing stake. But again, 2011, 12, 13, when mid-cap index fell from 8,000, 6,000, 4,000, again found large number of companies, promoters increasing stake. When post-Modi ji election 2014, when markets began to rise in 14, 15, 16, 17, we found less and less number of companies, promoters increasing stake. In fact, the lowest number of companies, promoters stake increase happened in the last 15 years was 2017. But look at this recent quarter, March quarter. When markets declined in 18-19 in mid caps, you had seen increase in the number of companies, promoters increase stake. But after a 20-30% decline on top of it, further 20-30% decline happened in March. Then you had seen a sharp bounce back in the number of companies, promoters bought. So effectively, March 2020, the number of companies, promoters bought is a 12-year high. But usually, this contrarian nature of promoter buying, this is only on the buying side. How about selling side? How do promoters dilute? IPOs, QIBs. Just take IPO market. How many IPOs India had seen in 2017? When the number of companies, promoter stake went up was actually the lowest in 2017. Number of IPOs in India was more than 54. That was averaging more than one per week. How many IPOs last 6 months? 2. But how many companies, promoter stake has gone up? 94. That's the inverse correlation that we are talking about. So in the next 2-3 years, if the markets do well, it is obvious you will find large number of IPOs coming in. When valuations are attractive, when market fancies few sectors, we will find more IPOs in that sector. Because when do promoters dilute? If you are, let's say you are a successful entrepreneur and you own 100% stake and you would like to dilute, when will you dilute? You will dilute when your sector is fancied by the market, your company is doing well, you appoint an investment banker, buy media interests, do roadshows, create investor interest, and then dilute. Just before diluting, you will also bunch all the good news, sometimes extrapolate also. And after you dilute, if the markets decline and your stock is down 50-60% because of some global financial crisis, some events, but your business is not proportionately weak, the stock price is down 50-60%, but your cash flows are same, your asset profile is same, there's no better investment you will make other than buying more of your own stock. Their comfort comes from the control they have. And their actions are also driven by their long-term outlook. It is not that this March 2020, they had greater clarity than you and me. We faced uncertainty. They also faced uncertainty. But they understand that in an Excel sheet, if I go and put 10-year cash flows and equities net present value of those 10-year cash flows, if my 1-year cash flow is 0, my net present value of all my future cash flows don't decline 30, 40, 50%. On the other hand, if my 1-year cash flow is 0 and the discounting rate that you use to calculate net present value is down 20, 30%, then the current value of the future cash flows are actually much higher. So this contrarian outlook is what helps the investors. It's not that promoters are great in timing the market. They have no clue about it. Their decisions are not driven by their perceptions of global economy, FII liquidity, market sentiment, all that. Their actions are driven by their balance sheet, their assessment of future cash flows, their assessment of their own liquidity. That's all. So this has been the case in almost cycle after cycle. But what is unfortunate is in such a large market like $2 trillion market, where we all know that more than half of the equity ownership is still with promoters. Should we buy when they dilute or should we buy when they buy? Recently, I did a presentation of two investors of a top 3 fund management firm. It is a listed company. They are top 3 in PMS, maybe top 10 in mutual funds, maybe top 5 in broking. Whichever aspects of financial services you take, you will find them in top 3 or top 5, certainly. And if I tell you the name, everyone will know. This company was 100% owned by the promoters till a few years back. And in 2007, they did an IPO. They diluted. Why did they dilute in 2007 instead of 5 years back or 5 years later? Is 2007 our capital markets players industry, whether it is broking company or fund management company, was getting 40 PE multiple. So if I'm a broking firm making 10 crores profit and my earnings are rising to 15 crores, then 20 crores, then 50 crores, and people are giving me 40 times multiple, and therefore on 50 crores PAT, if I'm getting 2000 crores market cap, I don't mind diluting 10% to raise 200 crores, which is what they did. And 2008, market declined sharply and their stock prices fell 50, 60, 70%, like many other Indian equity. But in 2010, 11, 12, as small mid caps were declining, their price also declined. And 2013, they announced a massive buyback. Promoters are actually cash rich. And company also was not fully leveraged. So they did a voluntary buyback at more or less the same price or little less price than the price at which they actually did a dilution 5-6 years back. And in the meanwhile, the balance sheet of this company has tripled, the earnings of this company has tripled, market price was almost same when 2013. And next 3 years, the stock went up 10x. And people are chasing and buying, and this was in many investors' portfolios great. And they had a housing finance kind of portfolio exposure, and when September 18 ILFS crisis broke out, the stock declined. Promoters didn't do anything, even though price fell half. But after a 50% fall, which was range bound for the next few months, when the COVID happened, from that price it fell another half, which means 100 became 50, 50 became almost 25. So what did the promoters do at that time? They again did a buyback, large buyback. So when I was presenting to their investors, saying that you are all trusting your assets with this firm, and have you ever asked how this firm earns money out of your assets? And if you have clarity of their earnings, should you buy when the promoters are increasing stake or should you buy when they actually dilute stake? And that is not applicable only to that company and that company's shareholders and clients. That's applicable to you, me, everyone. Which is one prominent reason why investors' experience in private equity funds are not that great in India. Because when you buy when the promoters dilute, usually you won't get a fair price. you will be getting more than fair price of the seller. Whereas in public markets, mispricing can always happen, both in bull markets as well as in bear markets. And promoters are quick to react to this mispricing. And that's probably because they don't have mark-to-market pressure. They don't have to justify their action to another person. They don't take 3 months, 6 months call. They don't ask many questions which we ask before we buy. Their buying, selling decisions are driven by their assessment of future cash flows, which could be wrong. In which cases, it is not that every company where promoter stake went up have gone up. Wherever promoter stake went up doesn't mean if you buy, when they buy, you will surely make money. But if you track this, it gives you enough signs of which periods of market we should be on the buying side, which periods of market we should be careful. Yes, Tarun. Next slide. Many times to model portfolios, people focus a lot of attention. I'm not suggesting that therefore this is great, look at the model portfolios done. But the reason why I wanted to cover this is these kind of stocks may be extremely volatile. In a rising market, they may rise a lot. And if you look at the next slide, in a falling market, they may fall a lot. And what happens is, in a falling market, they fall. In a bounce back, they rise sharply. And that's where the high beta nature of this comes, because if you look at the previous slide, in performing markets, they rise more because majority of the names promoter buying happens are contrarian sectors. And in contrarian sectors, for example, today or say 6 months back, automobile was a beaten down sector, most underweighted sector. 8 out of 10 news flow in that sector were negative. And if you go and buy these sector stocks, even if they had fallen from 100 to 50 and you go and buy, the ease with which it can fall to 40 is much higher. So while talking contrarian investing looks appealing, it's not that it is extremely appealing in the near the bottom, but you don't know the bottom. You may buy before the bottom, and being a contrarian, you may be down even in a rising market sometimes. So next slide, Tarunji. Next. This is again very important part of our assessment. What is interesting is, even though promoter buying was a lot in March 2020 and somewhat existed even last year, not much happened in 2016-17. But of all these companies that promoters bought, is there any commonality? There are different sectors, different size of companies. But one important point is, almost half of these companies where promoter stake went up are essentially zero debt businesses. Their financial leverage in terms of debt equity ratio, shareholder funds versus borrowed funds, maybe 0, 0.1, 0.2 in that range for almost half of the companies. In fact, 80% of the companies where promoters buying happens are companies where the debt will be lower than the owner funds. The reason is simple. When markets decline sharply, capital won't be abundantly available. In our industry, you may often come across the word deleveraging. What is deleveraging? You dilute stake and raise money and make balance sheet a lot more stronger with more cash in the bank. What is the opposite of deleveraging? Is spending cash and reducing equity, which is what is buyback is. If you are already leveraged, you would like to deleverage, which is raising cash, diluting stake, like what Reliance did. But if you want to leverage up, what is leveraging up? Giving cash, reducing equity. You can leverage up only if you are under leveraged. So in the same top 5 broking firm, wealth management firm, fund management firm that I talked about, their stock price fell 50% and then fell another 50%. During the same time, there is another similar broking firm, top 5 in the country, listed. Their share price also fell 75%. But they didn't do any buyback because they couldn't do buyback. If you have a 3:1, 4:1 debt equity ratio, how will you leverage up if you are already leveraged? So, if you put 100 rupees in every company where promoter stake went up, it is natural to find that your portfolio essentially has half of your portfolio is zero debt companies and 80% of the companies under leveraged. And if you look at corporate governance issues in India, there are different types of governance issues. But if you look closely, the nature of companies where you often hear or worry about governance are companies with debt. So if you have one rule in your book that I don't buy companies with debt, of course you will miss few opportunities. There are companies with debt and have generated good shareholders' wealth over a long period of time. But if you don't mind missing few of those opportunities and in exchange protect yourself from significant governance issues, this one rule can help dramatically. And that in a way also helps shadowing insiders, which is buying mostly companies where you find promoter stake increases. Yeah. Next slide. This is very interesting. This is a recent statistics. Please don't use this for stock picking, but this is given more to give you a sense of how contrarian thing not only works in terms of the timing of purchases, timing of dilutions, which is what we focused all along. That promoters bought aggressively in March 2020 and promoters did not buy in 2016-17. But of those companies that promoters bought last 1-2 years, what kind of companies did they buy? Some of you may remember as active investors that last 1-2 years have been this consumer discretionary space was highly fancy. Many companies were trading 40, 50, 60 PE. And there were quite few IPOs, dilutions that came in that space. But except for 2-3 companies, no other company had seen any promoter stake increases. But if you take this pharma industry, automobile industry, metals, and if you take shareholder returns in these 3 sectors last year, previous 1 year, 3 year, 5 year returns would have been next to nothing. And that's where you found significant amount of promoter buying. Next slide. So there are different types of companies, different size of companies where we had seen promoter buying and then subsequent price rise. Next slide, please. Sometimes long periods of no movement, promoters buy, and then you see it is not that promoters buy and immediately price jumps. Sometimes promoters buy and for a year it doesn't move and then it moves 4x. Yeah. And it's nothing to do with size of the companies. You may find sometimes even well-known large companies, promoters increasing stake. and sometimes it moves immediately. Sometimes in the right hand side you may find not moving for a long time and then moving suddenly. Yeah, next slide. It is not that all companies that promoters buying happens price goes up. When there is a fundamental change in certain businesses, if there is a fundamental shift in certain businesses, promoters buying may not lead to any inferences. Actually, in Tata Motors kind of cases, the buying is more strategic in nature than financial in nature. There are two reasons why promoters could increase stake. Promoters can sell for 100 reasons, like diversification, family settlement, raising money to fund some other asset purchase. But buying can be only for two reasons. One is strategic, where if they own only 30-40%, they may like to own absolute control. So they may like to increase to 51 and therefore buy market. Other is financial, because they think they will benefit out of making use of the underpriced markets. But even when they buy for financial reason, they can go wrong. If you take our universe, we had close to about, right now we have about 167 names over the last 2-3 years of promoter buying. But if you collectively take last 14 years, 2007 till date, about 11% of the companies where you bought when promoters bought, you held for 3 years and then sold blindly without even knowing good, bad company. And you just put 100 rupees in every company where promoter stake went up, which is a public information because all companies have to file shareholding pattern within 3 weeks after the quarter is over. So March quarter is over, 21st April, you just list down the companies where promoter stake went up and you call broker and tell him buy 1 lakh rupees in every stock in the list. You don't even know the spelling of the company name. And you hold 3 years and then sell. Then June quarter is over, 21st July, you take the list of companies where promoters bought, you buy 1 lakh rupees worth. If you had just done that over the last 14 years, 11% of the stocks that you did this transaction, you still would have lost money. In maybe 15-16% of the cases, you would have made single digit return, maybe as good as zero. Even though you bought after the promoters bought after the price declined, and you hold 3 years, you're still not sure. But in close to about 73% of the cases, the returns have been between 10 to 35% IRR. So what it does give you is two advantages. When you track this activity and necessarily don't invest when you have liquidity, but invest when large promoter activity happens. So you won't be buying in 2016-17, which is when the whole Janta was buying, and you will be an aggressive buyer in March 2020 when no one was buying. That's one value addition. The second value addition is taking contrarian view comes naturally, because your pool of ideas will always be little contrarian. And there are certain filters one can use. You have an edge in certain businesses, certain assessments. The biggest edge you have is you are small, your appetite is not as much as promoters. So sometimes what happens, promoters may know 100 is falling to 50, it could fall to 40, but they can't wait for 40. They may start buying at 50 itself because their appetite to buy may be large. Our appetite may be 100 shares, 500 shares, and we can wait. And we can buy in small lots, you can accumulate over a long periods of time and average out. Yeah, next slide. So what here I'm providing is just, if you take these, there are totally 277 companies where promoter stake increase happened last 8 quarters. Out of that, if you just take BSE 500 companies, could be about 160, maybe little less than that. I'm taking over a 2-3 year period, not just March. March alone, it was about 94 companies. So out of that, there are 28 companies which are in the large cap universe, about 37 companies in the mid cap universe, but almost 100 companies in small cap universe. And 75% of the companies that we have in our universe where promoter stake has gone up, it went up through market purchases. The number of companies in the other two may be small, but there may be some specific reason why they did that. Rights issues, preference shares. And buybacks will be small in number because majority of the companies that do buybacks, they do for dividend reasons. Any company where the buyback is being done, which is less than 1-2% of the company, we just ignore. We don't even bring it, even though promoter stake would have marginally gone up. But when a company does a 1% buyback and promoters do, it's not even 0.1, 0.2%, less than 0.5%, we just ignore. And that way, this gives you a sense of the large amount of promoters' activity in businesses where investors see risk and uncertainty. It's a good sign to take this inference. I don't know whether that will be helpful now or the next 3 months, but it will certainly be helpful not to fall prey to buy in near bull markets when promoters are the dominant sellers. Yes, Tarun. Next slide. In terms of sectors, you find all kinds of names coming in. That doesn't mean this sector, therefore, one should look at. But you will find the different weightages coming in. Yeah. Next slide. Next slide. Yeah. Next. Yeah. So this is, you find 3 lines. The blue line is Sensex, essentially large cap. Red line is mid caps. Green line is small caps. So obviously, little more than half of promoter buying happens in the green line. And the other 2 lines, maybe mid caps will be 25-30% and large caps may be 15-16% of the universe. So it's also important, therefore, to look at how these different market capitalizations move. So an optical inference you can make in all racing markets, you find red line growing much more faster than the blue line. Mid caps grow faster. Small caps, which is green line, that run up even faster. So between 2003 and 7, Sensex went up from 3,000 to 20,000. That's a 7 times rally. And during the same period, mid cap index went up 10 times. Small cap index went up 16 times. Right? Between 2003 and 2007, this is what. But all of these gains, they just lost in the next 10 months. So when markets decline, like in 2008, January to October, when Sensex fell 60%, mid caps fell a lot more and small caps got thrashed. And again, 2009, we had Congress government coming back, and that particular day when the results came in on 21st May, market went up 20% freeze. Sensex went up 20% that one day. And small mid caps did very well. Subsequent 1 year, you would have seen red line growing more than blue line and green line growing even faster. And 2013, we didn't have a global reason for the fall like 2008 or 2001. But 2013, Indian rupee lost versus dollar 20% in 1 quarter. And inflation was in double digit. GSEC yield almost came to double digit. It came as high as 9.3, 9.4%. Cost of borrowing was high. And all the corporates which raised money in 2007-8 bull market in FCCB, their tenure got over in 2012-13, and there was no FCCB market. So people were borrowing in domestic markets and returning liability out of FCCB, which was dollar denominated. So the domestic corporate borrowing went through the roof in 2011, 12, 13, and many of them are in bad shape. But when that pulled down the valuation 2012-13. We reached the bottom in September, and then Modi ji election happened. Markets went to. So again, there are two observations to make. First is, can you see where is January 2018? Yeah, this is January 2018. Just go straight top, January 2018, blue line, red line, green line. Till then, in all rising markets, mid caps rose, small caps rose even more. In all falling markets, they fell. But 2018 calendar year is the only year in the last 10, 15, 20, 30 years where you would have seen blue going up and the other two falling. Because many of you may know mutual funds reorganization rule, SEBI came. And the previous 3 years, 2015, 16, 17, the amount of equity inflow to mutual funds in those 3 years was more than the previous 20 years. So whatever investors invested from 1994 till 2014, they invested in 15, 16, 17. When such large money came into mutual funds, many fund managers who were running large cap funds were also investing in small mid caps. And SEBI came with a rule in January 2018 and gave about 6 months time and then further 6 months to make the mutual funds to define each scheme based on their holdings. And once you define a theme as large cap and show Nifty as the benchmark, you should not be investing in small mid caps. And if you take 2018 1 year, they had seen something like 38,000 crores of small mid caps being sold by the large cap mutual funds and invest in large cap funds. Therefore, 2018 is the only year of aberration. But rest of the years, we will find that. And even now, in March 2020, all the lines converged. So when was the last time it converged? 2013. When was the last time? 2008. When was the previous time? 2001. So in all market panics, you will find these indices converging. But post-convergence, what happens? In 2003, the convergence happened in 2001, but the bounce back started 1.5 years later. But from the time from the point of convergence, if you take 2003 and 4, the small cap index, what you find as a small uptrend, that's about 150% rally. Similarly, from the point of convergence in 2008, it started moving from May 2009, and the next 1 year return in small cap index was something like 160%. Again, in September 13, we had seen convergence when the bounce back started, the next 1 year return. So I'm not saying that therefore small cap is a great place to be in, all that. But usually, what you will find is many experts saying in market panics, you should be with the large caps. But in reality, in all these panics, and at the time of bounce back, what bounces back more is actually small mid caps. Part of the reason is not that small mid caps are a great place to be in. Major part of the reason is before this convergence, small mid caps would have fallen the most. And therefore, even for a minimal effort, the bounce back is very sharp. But the only challenge, the biggest challenge, is even if you are fully convinced with this theory, it is not that the same small mid caps which rallied in 2003-4 rallied in 2009-10. And it is not that the same small mid caps which rallied in 2009-10 rallied in 2013-14. And it is again not that the same small caps which did well in 14-15 bull markets were the ones which are doing now well. No, it's a different list, which is a function of companies, sectors, the earnings profile, asset profile, many of those. So at the end of the day, tracking all this, discussing gives you some kind of a oversight of what's happening. We all focus on one type of sellers like FIIs or one type of buyers like mutual funds. But the biggest elephant in the room is the promoters, and it makes sense to observe what they are doing on their holdings. And that's the point I wanted to convey. Thank you so much. Happy to take questions.
Thank you, Mr. Maran, for such insightful discussion. So, Mr. Maran, I think the next part, I think where you can really help us, all of us, is around your insights around current markets. I think we all are very unsure that though the economy situation is not great currently, everybody has concerns that actual earnings of every person in the country is going down. How can the market run up so much in this last 3-4 months, what we have seen? So is market running ahead of reality? Any lessons from your past experiences you can share that may be very helpful for everyone?
It's a long topic.
Yes.
Actually, it's a wrong perception to carry in investors' mind that as if stock market is an indicator of Indian economy, as if it is some barometer of our economic progress. It is not. Market is in India. Stock market is different. Economy is different because of composition. Today, most people look at Sensex and Nifty as a reflection of market, but 35% of Sensex and Nifty are private banks, which is not even 6% of GDP. But 15% of GDP is real estate, which is not even 2% in index. So if real estate do badly, GDP will do badly. Index need not have to.
Correct.
But if private banks do well, index will do well, GDP need not have to. For example, if you take IT and textile, last year both did more or less same impact to GDP, same size of impact to GDP. Both IT did about 150 billion exports and maybe 20-30 billion domestic, so 170-180 billion size IT industry in India. If you take textile industry, it does about 145 to 155, very close to each other. But IT industry may have 43 lakh employees, and textile industry has 4.1 crore employees. So if textile do badly, and IT do well, both at same percentage points. Let's say textile did minus 10%, IT did plus 10%. The impact to GDP may be more or less same, but the impact to employment numbers will be dramatically different. The impact to the multiplier effect of textile industry is 7 times, 8 times GDP at the GDP level than IT industry. So some of these macros are, your heads will spin if you look at that way, but we should not conclude therefore that market is running up because economy is doing badly. And in the last 20 years, we have one graph where we put x-axis nominal GDP and y-axis Sensex return. And if you draw a 45-degree slanting line connecting these two, you will never find any annual performance of GDP and markets correlated. There are years nominal GDP has grown 10-15% per annum for 3-4 continuous years, and markets have given negative return. And there are also periods where the economy would have grown 2-3%, market would have grown 50-60%. So what is important to market is the earnings growth of the companies which are listed. That's it. Right? The earnings can come either from higher turnover or higher margins. Sometimes we link higher sales as higher margins, higher profit. They're not. Between 2002 and 2008, corporate top line growth was only 16%, but bottom line grew 27%. What is 27% per annum over 6 years? You just take Nifty companies between 2002 and 2008. Their net earnings grew 27% per annum. That's about 27% for 6 years is close to about 4x. And next 6 years, that is 2008 to 14, top line grew the same 16-17% for Nifty companies. But their bottom line did not grow even 7% per annum because margins shrunk. Why margins shrunk? When your sales are doubling, how come margins shrunk? Because your capacity went up more, your utilization declined, interest went up, depreciation went up, sales went up, but earnings declined. So market valuation is about earnings. It is not about economic activity. So tomorrow you go and demolish all the bridges in Bombay and rebuild.
GDP may go, but the earnings of corporation may not. Tomorrow, if all these cement companies in India double their capacity, we have today close to about 500 million ton capacity. Each million ton costs 600 crores. So 500 million ton will take 3 lakh crores. So for all these cement companies in India spend 3 lakh crores in doubling their capacity, buying new land, buying new machineries, giving employment, growth. But if already and if existing 500 million ton, 100 million ton is idle. So the new 500 million ton will be idle. So your sales is not going to grow. Your utilization will decline. Your depreciation will go, interest will go, your earnings will collapse, share price will collapse, but GDP will go. So we should not therefore take point-to-point relationship between economy and markets, because the composition of what we are looking at as two different numbers.
So great. Mr. Maran, there are a lot of questions coming in. Before I take some questions, my sincere request to anyone who is interested to ask questions to Mr. Maran, kindly use the Q&A box and ask your questions. For next 10-15 minutes, we will try to cover as many questions as possible. So, Mr. Maran, there is a very interesting question coming in from Mr. Vikas K. And before I speak his question, there is a very interesting document I read. Apple CFO, there was a quote, Mr. Luca Mestri. From last 4 or 5 years, Apple was buying stake in there was a lot of buyback happening in Apple. Almost $600 billion of buyback happened in Apple. And this was one of the best investment ever done by Apple. And this is worth $1.2 trillion as we speak right now. So coming from that background, the promoters buying in their own company, Vikas has a question that promoter on the whole are an over-optimistic lot. So how do you separate over-optimism from buying for economic reasons? And I think it's a very valid question that any pointers which makes you feel that, no, this is not a right decision.
You gave Apple example.
Yes.
Lehman Brothers, 8 months before they went default, did a buyback. That's a foolish decision. No? Had they not done buyback, they would have left with more cash in the balance sheet, which would have probably helped them to survive.
Okay.
So, a company doing buyback, US context is different. For example, the last 10 years that the US markets have gone up almost 3 times. Who's the biggest buyer of US equities? Actually, it is the buybacks. $4 trillion have been used by US companies in doing buybacks last 10 years alone. No institution has bought 4 trillion worth of stock. Right? No, it's not that all the institutions put together has not bought 4 trillion worth of stock. So companies are the biggest buyers. But that buying decision is done by an independent board. It's a professional decision. And many corporate balance, for example, if you take S&P 500 there, the corporate debt in US is today $9 trillion. It's a historic high. So balance sheets have been leveraged to do buybacks to improve the earnings per share. Right? Indian companies don't do that. Our debt today is less than what it was 10 years back. And that's why I said financial leverage in these companies is very attractive, because in India, banks cannot finance equity purchases. Promoter cannot borrow money to do buybacks, to do creeping acquisition. So you cannot have an institutional flow of capital for a capital markets buying. Right? So some of these may look like old age rules, but these old age rules actually help in preventing speculation from creeping in. But when we use the word optimistic, optimism is not, it can be loosely used in different contexts. It can be used positive way, it can be used negative way. The over-optimism, if it is over-optimistic promoters who are buying, over-optimistic promoters will not be zero debt companies in the first place. Majority of the companies where promoters are increasing stake are companies which may have 15-18% return on equity and they may not have any debt. Okay, today out of these 167 companies, there are more than 100 companies which have more than 20% return on equity and no debt. And cost of debt is only 9-10. If you are an over-optimistic promoter, you should have at least leveraged 1:1, borrowed at 10, and your return on equity in business is 20. By doing the double the capital, maybe ROE may fall from 20 to 18, but still 18 is 18. Your cost is 10, and the balance 8. If you increase, your ROE can be increased further to 25 or 30. If he is an optimistic promoter, he would have done that. Optimism can be taken in a positive manner. I actually kept that slide as a reserve to use in the last leg, which I can use now. Let's go to the next slide.
Yes.
This is for investors. Bull markets are always born in pessimism, grow in skepticism, mature in optimism, and die in euphoria. But when should you be optimistic? Should you be optimistic in euphoria? Should you be optimistic when there is all around pessimism? So, going by the promoter activity level, at least in the chart that we have shown, if there are a record number of promoters buying in March 2020 and the same optimistic promoters are not buying in 2017. So I think that statement is correct. Promoters are optimism. Most of the successful entrepreneurs are optimistic by nature. And majority of the people who actually achieved anything like are optimistic in the first place. But their optimism should be rightly placed. This is a sensible optimism, right? Promoters' optimism. It is not mindless optimism that they were exhibiting aggressive buying in 16-17, which investors were doing, right? So these promoters by nature are optimistic, but they are very contrarian. Their optimism comes when everyone is pessimistic, when everyone is skeptical. They are not optimistic when everyone in market is optimistic. And when everyone in market is euphoric, they actually dilute.
The smart lot. That's the smartest lot. Another very interesting question from Mr. Amit Pansari. Why zero debt is encouraged, while we clearly know that cost of debt is much lesser than cost of equity?
That's what fund managers and investors talk. Promoters talk different language. For them, cost of equity changes every month, every year. Sometimes cost of equity changes morning to evening to them. Right? So cost of debt is a number. Cost of equity, it's not one number. The reason is, for example, you take the top 10 consumer companies in India. Return on equity of Hindustan Lever is 82%. Nestle, ITC, all these companies you just take, Colgate. In the last 10 years, the volume growth of Colgate is 2% per annum. Their working capital is almost negative. Their return on equity is, say, 40, 50, 60%. And they are not growing at that rate. So why do they need debt? Right? Where is debt very important? There are many companies that we buy where we are okay with debt. If, for example, if you are an LNG supplier or a bulk material handler or an utility company where your return on capital employed is 12 to 14, but that's highly visible 12 to 14, not prone for any volatility. There, if you are doing 1:1 leverage at cost of 8-9%, and instead of deploying all the 100 rupees to earn that 12 to 14, if you deploy 50 rupees and leverage 50 rupees, and then the difference between 12 to 14 to that 8 to 9 cost of capital, your return on equity can be 16-18, right? Where it is highly visible. If it is unreliable 12 to 14, which means 4 out of 5 years you will make 12 to 14, but 1 year it could be minus 20 kind of risk. Certain promoters don't take it because in that 1 year, your leverage you may not be able to carry in the books. So if that is the case, then most finance companies should be alive for a long periods of time. No? Every 10-15 years, you find half of them in the industry going away. Why? If their cost of equity is only 8-9, cost of debt is only 9-10%, and they anyway lend 12, 14, 15, 16%. So the cost of equity is not one number. It is not correlating with the cost of debt. There are many businesses where you don't need debt because your return on equity is high and you are not growing business as much. They may need debt only to do acquisitions or diversifications. So their regular business may not need debt. But those other businesses where you take debt, you should not. You take debt for what? To fund a new project, to fund a new business. There are many in the auto ancillary space in their growth phase took capital. But many of them, none of them take capital after reaching that stage. It is not that they look at financial engineering. Financial engineering is getting closer to your ability to sustain some black swan events. And therefore, majority of the companies which are where promoters are contrarians and buying aggressive times, at uncertain times, they will be usually under-leveraged companies. At least with the limited market space that we are looking at, majority will be under-leveraged companies.
Sure. I think one very interesting question coming in. So based on your promoter buying and your experiences, what is your best investment where you landed serendipitously? And second is your bad investment and what you learned from it.
I don't want to highlight any specific name. There are a lot of disclaimer issues, and but the good investments, there are good bad two types. There are actually 4 types of thing where it is a good decision with a good outcome, which means we all made profit. And there is something called good decision, bad outcome. Sometimes we take bad decisions, but with a good outcome. That is what is luck is. Sometimes bad decisions and bad outcome. So where do you feel very disappointed? Is only one out of these 4. Where you took a good decision and outcome turned out to be bad is where you feel very disappointed. But where you took a bad decision and the outcome was bad, it hurts us because our portfolio returns could decline, investors' returns could decline, but you can't blame market for it. So stupidity in stock selection is a stupidity in your assessment of the promoters. Because I'm not buying because promoters buy. No one is forcing you, right? As an investor, you should buy when promoters buy. Promoter buying is just an indicator. It makes you to be a good contrarian. But because promoters are buying, these names should come into our universe, which no other way it will come into our universe. We'll be busy doing something else. We'll be busy looking at some other names. But once it comes to the universe, then you should ask the right type of questions, which makes right type of decisions, good decisions. So when you take good decisions, outcomes usually will be good, but sometimes it can be bad outcomes. For example, the biggest change could be the promoter's assessment of future cash flows will be based on his past experience and current industry structure. There could be someone who is playing out. For example, if it is a capital market, and how many of us knew 5 years back a zero the kind of guy can come and disrupt the industry? So it may be a good decision, but it could be a bad outcome if you are invested in brokerage industry. But it can be a good decision, good outcome had you bought ICC securities. In the same industry, which was consolidating, what is ICC securities average brokerage revenue say last 3 years? 0.3, 0.4, including last year. So how can someone can maintain that kind of high yield when someone is almost disrupting the industry with zero brokerage? Is also a good decision, because you should look at what kind of investors deal with them. You should ask the question, what is their size? When did they start? What is the technology supremacy here? And what kind of first mover advantage you have? If this company has 11 lakh customers, 8 lakh active investors, many of them do 5,000 to 12,000 rupees brokerage. Will a guy who is a professional living in Gulf, doing 3 trades a year, spending 5,000 to 12,000, is he going to be concerned with 0.3? Just go and try closing an NRI account, opening an NRI account. There's a lot of what we call as first mover advantage in these businesses, and there is a limit to which you can milk that advantage. You cannot tomorrow increase your brokerage rate to 1% and still expect all your clients to retain. But because your commercials is 0.1, 0.2 higher than the industry average, it's not that many people are going to jump off the ship. And the industry consolidated. If you take the brokerage industry, say again from broker number 20 to broker number 100, most of them lost business because business has been shifting technology-wise, capital adequacy-wise, from least capitalized brokers to well-capitalized brokers. Different industries had done that shift. So, for example, last quarter, Birani earnings doubled. Right? Doesn't mean biscuit consumption has doubled. Actually speaking, biscuit consumption has not grown. Half of the biscuit industry is unbranded, unorganized, regionally branded, and loose biscuits, which you often find in the glass container outside a tea shop. And April, May, tea shops are not open. Even if you produce, you cannot sell. But you are not able to produce because your factory is not operational. You are not complied with regulations. But Britannia could do all this. They retain labor, their factories were running, and there were products right in place, inventory they managed, logistics they managed. And in an industry which hasn't grown, they have grown, but how much they have grown? Maybe 10, 12, 14% in volume. But the earnings doubled because during the same painful period, that painfulness was more for the small regional players who didn't buy the raw materials, and milk procurement prices declined, margins expanded, earnings doubled. So you need to look for those kind of situations. Yeah.
So we will take the last two questions. Before that, I am just launching a poll because many people would like to exit also. So kindly request everyone to take this poll questions. Yeah. If all of you can just quickly take this poll, it will really help us to make these sessions in future better. Yes, Mr. Maran, you can take a break till then. Request everyone to kindly take the poll, please. I can see almost 20% of them have taken the poll. Yeah. So till the time the poll answer comes in, Mr. Maran, another question is, what is the impact on the company which is changing his strategy from B2B to B2C and increasing their promoter holdings? Any insights on that?
No. Both are not connected. Both are two. Sometimes it happens in few companies, but the decision drivers are too different. It is not that promoters increase stake because they are shifting from B2B to B2C. The transition from a B2B side to a B2C side is not easy. It's very hard.
Sure.
You can scale up in a B2B quite fast. In a B2C, it will be like hockey stick. You may not move for a long time and then you will move like hell. But the perseverance during the flat side of the hockey stick, not everyone has, and not everyone can. Even if you have that perseverance trait in your personality, your balance sheet and your financiers and your shareholders' help may not exist. So the failure rates in B2C are much higher in that flat side of the hockey stick. In B2B, it will be quick to correct your situation. You would not have spent too much money in advertising, brand building, distribution, so that in a B2C, correcting some of your mistakes will cost a lot of money, and correcting mistakes won't get back that money. It's gone. In a B2B side, you'll be quick to recognize the mistakes, and if you recognize mistakes, some mistakes are correctable, which is why all the B2C side of the business will have a huge premium. The earnings may be less, but the premium comes because your pricing power is much higher in future.
Sure.
So B2B conversion to B2C and promoter stake are not correlated.
Sure. I can see almost, thank you, Mr. Maran, almost 70% have taken the poll. Request the balance 30% also to take this poll. And I can see a lot of satisfaction to everyone who has attended this session. So congratulations, Mr. Maran. Everybody is very happy and a lot of people have got a lot of insights from this session. One last question I'm taking from Mr. Milan Shah. His question, and I think we can see last 1 quarter, there is a huge run up in pharma sector. So his question is, you mentioned pharma along with auto and metal, but did not pharma had an exceptional bull run in last 3-4 months?
Yeah, the promoter buying happened before that. If you take that number I gave for 2018 and 19, the number of companies where promoter stake increase happened in 2018 and 2019 were in these sectors. So pharma was not performing sector in 18 and 19, which is when promoters have actually increased stake. For example, now that pharma has had a spectacular run, will there be any companies in pharma in the next 3 months? Unlikely.
Sure. And how does a retail investor track and implement strategy around insider buy sell?
Anyone can do it. It is not retail or law. None of the information that we use here is privileged. None of these data points is something which costs money. Because as you know, if you go to bsindia.com, you can list down all these corporate filings. NSindia.com is free. It doesn't require password. Anyone can do it. But it takes time, effort, money to track on a daily basis. And some retail investors who have time and passion and inclination can do it. But rest of the people, how can they use is at least to avoid traps. This one chart, those investors can use. And it will be too hard to resist the temptation not to buy small mid caps in 2016-17, right? And you should be able to resist that temptation because you know, boss, why should I buy when the guys who are running the businesses are diluting? Right? There are some people who ask, is ESOP selling also promote dilution? It's not. Employees selling because some of their part of their compensation was ESOPs, and instead of getting salary, they got stocks, and so that way spending your salary is not a negative thing about a company. But if there are companies where employees are given ESOPs, which employees never choose to sell for a long time, and suddenly you see spree of selling, then red flag should be raised.
And I think we have one of that red flag coming recently. Yeah, and I'm sure we can have a very big discussion around it.
Yeah, and these kind of insights retail investors can easily make use of. If all this, if my 2-hour session can help you to avoid some of your mistakes, I would be more satisfied person. Whether any of you learned how to make a profit trade, that is secondary. But if you know how not to lose money, how to avoid common mistakes, how to create clarity around the myth, I think that will help you to become maybe one notch slightly better investor than what you are already. Thank you very much. Thanks, Tarun, for your for the opportunity. Thanks, Mr. Doshi.
Yes, Rashesh, over to you. Over to you. Thank you so much.
Thank you very much, Tarun, and thank you, Mr. Maran, once again for spending this precious couple of hours to help us learn more about the equity market. Once again, thank you everybody for joining in for today's session. This session was brought to you by Roundtable India, an organization of members below 40 working together to make an impact and making the society a beautiful place to live in. I wish you a very lovely weekend, a happy Independence Day for tomorrow, and may God bless you and keep everybody safe. Thank you so much.
Thank you so much.
Thank you. Thank you.